Alrighty, we are live, I believe. So yeah, hello to everybody who's watching us at the moment. We are having this session because we are all keen to help startups and companies move faster. And there's a very interesting and still quite underground instrument for this that we are focusing on today, which is revenue-based investment or finance. Yeah, we will be going on this, talking about this topic from different point of views. We got here from legal side, we got a startup, we got two funds. Without further ado, actually, I would like to that you guys would do a short intro about yourselves. Myself, I'm let's say a moderator for today, but actually these guys who are here have all the knowledge and experience. And from Beamline Accelerator, then myself and Miriam, would you start? What's your background?
Yes, thank you, Carl. I'm Miriam Marastu. Your office is the company I represent, and I'm entrepreneur, legal advisor, consultant, and I have been active already 20 years almost, and in startup business since 2007.
Alrighty. Ottomar, take it away.
Hey guys, my name is Ottomar, and I am one of the co-founders of Dreamsville. Dreamsville is a company that designs, develops, and produces betting products. And yeah, we're pretty much first year live with the Dreamsville brand, so all is going well.
Alrighty, Indrek could be the next one.
Hello everybody. I've been in startup scene as an investor, mentor, coach, and everything else for last 15 years. Last 10 years I've been into clean tech startups, and I'm one of the founders of Clean Tech Estonia, clean tech startup support program, and I'm also working with Beamline Accelerator together with Carl.
Cool. Stefan.
Yeah, hi everybody. Stefan Nagel. I'm managing partner at Round 2 Capital. We are a Vienna-based fund focusing on revenue-based finance, and I think we'll talk about that in the next hour and a half. Before doing this, I spent a lot of time as a consultant at McKinsey & Company, focusing on clients in tech, telco, and software, already on the strategy and corporate finance side, and now for also more than 5 years as an investor, with Round 2 as a fund, but also as a business angel.
Okay. So as you see, quite a varied bunch of people here who are all connected to this instrument one way or another. But first of all, could you, Stefan, bring out like what is it actually? What's revenue-based finance? What's been happening and how you got involved into this?
Sure. So revenue-based finance itself as an instrument is nothing that is completely new, right? Similar terms for this are royalty-based finance, for example. And royalty-based or revenue-based finance has been around for many, many years, predominantly in the media industry. That's how a lot of films, etc., get funded, or even theater shows. But also large mining projects, and in some cases also pharma development, right? But at some point, and starting in the US, it started to get used as also a method to finance software companies, or basically companies with a digital business model. And that basically was also the entry for us to get started with Round 2 back in 2017, basically looking at the European landscape and saying there need to be more financing instruments out there, given that the only option truly that was there is the standard progression of equity rounds to fund new companies. And on the other hand side, banks being essentially unable to properly fund companies with a digital business model or basically intangible assets as their predominant source of value and business generation, right? So that's how we got started, how we adopted the product itself, also for the European context. And the way it works, very shortly in general, is the companies receive an investment in revenue-based finance, and I think we'll get into the technicalities also a bit more later. We structure it usually as subordinated loans, but then there is no fixed period attached to it and no fixed interest rate. But what funds like us get is a share of the revenue, right? And the share of the revenue is just expressed as a percentage of the revenue, and that then continues to develop, fluctuate, and of course, hopefully grow with the development of the business. And then, at least in our model, the revenue-based loan ends when a cap is reached. So what that means, if we make a 1 million investment and I, over roughly 6 years, want to have 2x, so 2 million back, then basically the whole financing stops when all the revenue shares in accumulated manner have added up to those 2 million, right? And then basically it all depends on how quickly the company develops, how quickly the company grows. If the company grows quicker than expected, then we reach the cap earlier, then we are happy, but then usually the company is happy as well. So fundamentally, we believe, it's an option to get financing that is non-dilutive. It's much easier to set up as basically an equity round where you need to deal with a lot more legal topics, you need to deal much more in a much more complicated way with governance topics. All of that is not part of the revenue-based financing, and there's a clear kind of endpoint attached to it. Yeah, and of course, all of this and the potential other upsides we trade against having just those continuous cash flow streams from the revenue share. But it's very predictable. The interests are completely aligned, essentially, between us and the companies in terms of growth and development, and it works very well. Last comment on this. So we've tested this we are present in a couple of markets in Europe. We're in 7 countries where we've established the product itself. So it works and holds water. We have 23 portfolio companies, quite a number of them already on the second round of financing. Yeah, so I think it's well established. And of course, there are other players around now as well who are already getting in earlier. So we are really truly growth investors, basically getting in when companies reach 1 million euros in revenues and above, right? That's where we feel we have tailored our product quite well to. There are other, as I said, more people coming to the market, getting in earlier with smaller tickets, but also on the higher end. But we believe there is just still so much of opportunity out there and so much potential to grow when basically truly a broader mix of financing instruments is just out there and available for startups, young companies, growing companies.
All right. Thanks a lot. We are getting already a lot of questions in, so all the viewers as well. Thanks a lot. Keep it coming. Just before we get into these, we would just like to give a brief overview as well of one startup story as well, and that could be Ottomar. Like, what's your experience in this? How did you find out of this method? When did you yeah, how did this go with you?
Sure. So I think it makes sense if I briefly go over the background, how we got to the point that we could make this decision to partner up with a fund that offers this kind of an instrument. Initially, when we started back in 2019, the founders team invested their own money into the business. So meaning that Our skin was already in the game from the really beginning, and initially we didn't use the approach, or our mindset wasn't targeted in a way that, okay, we definitely have to raise capital, like, I don't know, in a year or so. We slowly got started. We produced our first products. We established first channels to sell the products. We learned how and how different markets, how different channels work, and made adjustments accordingly. So the story was that like when we started back in 2019, we initially got like revenue in which was roughly 50K or so, which was in 2019, and back in 2020 we reached a revenue target which was a little over 100K. So now coming back to, or going to the end of 2020, we saw like immediate response from the supply chain, logistics, everything like that, that kind of put us in a position where we understood that, okay, we want to go further with this. We want to develop more products into our product line. And we kind of felt that, okay, let's see what's out there. And we started doing research. And luckily, we found a local fund here in Estonia who is capable of, and who is willing, and whose main instrument is also revenue-based investment. So in the beginning, it was a new concept for us as well. And it took us really like 3 months to get the whole picture together. In principle, the due diligence, the communication, getting into this partnership, it was pretty much hassle-free, because we had already proven that we can make money, we can grow the business, but we need this kind of a leverage that could also help us to the next level. So when we got the concept, got the understanding what this practically means for us, we immediately understood that this is the most, let's say, the title of this talk is also like founder friendly. So yes, I agree. This was a friendly proposition for us, because like it gave us the opportunity to not take the cap table out of balance in a way that we could keep the same cap table. We had already a very good understanding where we want to go with our developments, which already kind of gave us the kind of encouragement that, okay, this is something we can benefit from. And we finally got things wrapped up in March 2021. So within this time, we have already shown a beautiful progress in terms of our sales, our product development, and our team building. So this is pretty much the let's say the whole story in a nutshell.
Okay, and what would you say are for the RBF, what did it allow for you, and what do you think about even like the method itself?
Yeah, so definitely, as I already mentioned, the cap table balance, meaning that you can kind of work together with the same people, because like we already had a very clear understanding where we want to go and what we wanted to achieve. So we didn't have to kind of play around the whole kind of the bureaucracy, the negotiations, the in-depth due diligence, like, and so on. So the paperwork was like down to minimum, which was really, really good. Secondly, I think this gave us an opportunity to grow in our own pace. This is like, maybe it sounds like weird or not, but the point is that we, in our business, we have to look everything as a marathon, right? So we know that it's a long game for us, because like we have to test our products, we have to get feedback from the market, we have to make adjustments, we have to build our service to match the needs of the users or our clients. So we had a good kind of establishment for this kind of a runway. And maybe thirdly, I would say that yeah, like maybe it connects to the second point, but the hassle freeness or the paperwork was down to minimum, and I think it was so enjoyable that just because we had a really good connection with the investor, we had a really kind of like a good report in terms of what we want to do, how we're going to achieve this. And obviously the reporting is as easy as it can be. We only have to show our revenue on a monthly basis. Yes, obviously we're having like regular chats and discussions if there's a need for it, but in general we are independent, and this is super important.
If I may ask a question before I go to my introduction to Ottomar. You mentioned how well the particular investor's kind of attitude fit to your situation and your wishes, that you are not hurried unduly, and then you can do it at your own pace and so on. Do you think it's characteristic to that particular funding instrument, or is it up to that particular investor? So maybe with convertible note or classical equity investment, the same investor would still be the kind of relaxed. I think I know which investor you are talking about, because there is one person I know who is this kind of relaxed.
Yes, good point. Again, like as we didn't only talk to them, we talked to different investors. We definitely wanted to find a match between our attitudes, how we see this. So in our case, yes, we immediately recognized the fact that it's going to be a long game, and therefore we wanted to partner up with someone who understands that concept. We are not in the digital business. That makes our position different, right?
So it's not up to that revenue-based funding, it's up to the particular investor. Maybe some investors using the same instrument are going to stress you up very, very much.
Yes, it can be so, yeah. I cannot tell for sure, but it can be so, yes.
Cool. Okay, few words about myself also and why I'm here. When we started last year, when we started building up the Beamline accelerator, sorry, then it came to our attention that revenue-based funding might be the kind of interesting funding instrument which is more win-win than any other instrument right now on the portfolio of many investors and in cap table of many startup companies, meaning that it was preferred when we were doing initial interviews. It was preferred way of getting money on board by the startups, and it was actually preferred way to investing by many investors also. That was the strange finding for us, and I was actually quite surprised why this kind of amazing instrument wasn't used before in large scale, at least in Estonian ecosystem, when we know that startup investments per capita are highest in Europe, maybe highest in the world. I don't know the latest statistics. So, but yeah, here we are now. There is a Beamline accelerator using this instrument in the new upcoming batch, and there is, at least as we heard from Ottomar, at least one more investor on the market who is doing this kind of things. Maybe I'm going more in detail, or we together with Stefan, Ottomar, and Miriam are going more in detail how this works and why it's best for both investors and companies a bit later. If there is no urgent questions, then I will give the opportunity to introduce to Miriam also.
So from a legal perspective, and I have seen that it has already risen some questions, it's a loan. So it's a loan, but what makes it different is that the loan interest fluctuates. So the loan interest depends on the amount of revenue. So that makes it very attractive. And as Ottomar explained, I think it's especially attractive for the startups. And since the investors are eager to invest into startups that believe in their business and are not willing to let equity go, so in that sense, it should also work well for the investors. But I agree that it's more for a mature investor who perhaps understands the complexity of investment slightly better and understands that revenue-based investment could in the future give actually more than equity stake at a company. So it is a very interesting investment vehicle. What I have seen in my practice that it's used by investment funds and actually limited partnerships in Estonian Usaldusfond is actually they work in a similar manner. So it's if you acquire a share in the limited partnership, then what you actually acquire is the possible revenue in the future. So in that sense, it also has its own legal form, but partnerships are legally quite complex. So this revenue-based investment model, it actually gives the same opportunity. So it is definitely interesting, and I'm excited to see that there are also interested investors in Estonia who are and also success stories, as I can see from Ottomar. But Ottomar,
I wanted to maybe highlight one very important thing: revenue-based investment, as it says in the name. You usually should have revenue to apply for this kind of an instrument.
yes.
So starting from zero with an idea, I think it doesn't make sense to kind of approach these kind of funds.
Yes.
Well. Here's a small catch from our side, because that's the thing that's been missing on the market, what we see at least. So Indrek, would you care to share Beamline's vision and what kind of startups actually we are looking for, and what's the our experience?
Okay, so you want to say that we are the idiots who are giving out revenue-based loans to the guys who don't have revenue, right? Actually,
Exactly.
we need our background check, and I will explain it in a moment. I wanted to do, I don't know, is it opportunity for so-called product placement or not? But Miriam, if this is loan, but without fixed interest rate, how you account this way? How you treat this in your accounting, and can you recommend accountants who can handle this?
So from an accountancy perspective, of course, you record first the principal amount of a loan as a debt. So that's regular standard. And of course, you can only record the interest once the revenue or the amount of revenue is clear. So this is not something that you can automatically report. You don't have some kind of minimum interest that you record in the bookkeeping, regardless of what is actually happening with the revenue. So once the revenue is clear, then you can record the amount of interest
So it's treated slightly differently than the conventional loan.
Yes, it's definitely different, because with conventional loan, you have agreed interest. There might be also some part of it that fluctuates, for example, Euribor, or no, it hasn't fluctuated much in the past, the immediate past, but also the regular loan can have this fluctuation side on it, but it's more guaranteed. But for startups, of course, it also means it's guaranteed obligation that may weigh quite heavily.
Yeah. Viewers also saw your link already on the screen. So everybody who wants to know more about it, please contact Miriam directly. Because I don't think the technical details of this are too important here. Anyway, to answer the question asked earlier, then yes, we are in some fashion, we are unique. I don't know, is it in the whole global scale, but at least I don't know any other early stage accelerators nearby who do this kind of format as we are trying to do. And it seems, at first glance, it seems stupid because we are basically given revenue-based loans out to the companies who don't have revenue yet. But there are few details which encourage us to do it. First is that we have been in this clean tech startup, early stage startup development and support business since 2015, basically. That's how far our activities go back as a team. I just collected the data from one of our business development programs from 2017 to 19. Over 3 years, we supported 19 projects there. Out of 19, 12 have revenues today. Of course, we have done the similar program also in 2020 and 2021, but these companies are a bit younger. The percentage who have reached the revenues is not so high. And we have to take into account also that if you know the background of Cleantech Estonia, then we are non-profit, and we have done this kind of non-equity grant-based and just for free business development, business support programs, and perhaps we haven't even selected so carefully these with so fine these companies who have entered to our programs, but still out of 19 we got 12 to the revenues. So that mathematics says that if everything works out, if all these 12 companies return 2x the money put into them, then we are in positive, basically. So it doesn't so much matter if the companies are making revenue right now, if we have good faith that they are getting the revenues within next couple of years. And practical sample shows that we are able to select the companies who reach the revenues within 2 to 4 years with surprisingly high success rate. Also, we have in our agreements with the companies, we have maturity date. So if the companies don't reach the revenues to certain maturity date, for some reason the development cycle turns out to be longer, or if there is some unpaid balance at the end of maturity date, then it converts as a regular convertible note. But the length of the period of this revenue-based agreement and when the maturity date is going to be, this is matter of negotiations with particular companies. So I can't tell you what the standard terms are here. That's basically the justification why we are doing this kind of silly thing here.
So I'm actually reading one comment in the comment section that like you're betting on the long game, right? That's how I understand it as well. Yeah, it's a marathon, not a sprint.
And I think the convertible note in the end that also mitigates risks for the investors. So it's not kind of a pure RBI model, but it's a good mixture.
It's RBI if everything works out as it's supposed to work out. Convertible note is kind of backup option.
Yes, and actually it's also kind of collateral. So it's because it's as with any loan and with any debt instrument, it's possible to have collateral, and your collateral is the possible conversion in the end.
Yes, exactly.
Stefan, could you please comment on collaterals in your experience?
Yeah, perhaps let me also just quickly address end of maturity kind of discussion, right? At the end of the day, I think what we decided to do, but it's also just due to the fact that the companies are a bit more mature when we get in, right? And we can talk about the kind of companies, etc., also a bit later. We at the end decided to not basically put an end of maturity remedy fixed into the contract. So end of maturity in our case means, yes, the remainder of the loan and the remainder of the royalties filling up to the cap are due. But then actually we have the flexibility to negotiate whatever the best approach is. And that might be a conversion. That might simply be because the performance has been good enough, or at least has been good enough, especially over the last 2 years, but it has just not been enough to fill up the cap yet, because perhaps the first years were too slow or slower than expected, right? All of those different things can happen. And then we might just be rather interested to refinance the loan and just have essentially a prolongation of the revenue-based relationship, or do something else entirely, right? At least for us. And then that's different when you talk to earlier companies where you really just have the founders. But for us, we have situations where already a couple of angels have invested, or there might already be other investors in there. And then if you have this basically prescribed solution of it needs to convert or it needs to turn into a convertible, then that basically makes the process of getting everybody on board at the beginning of the loan more complex, right? And then one of the things that we are actually by now also quite confident to go out there is to say, the beauty of the revenue-based relationship is at the end of the day, when we have our money back at the end of the day, the relationship can also end, right? And that also means we can be refinanced at any point in time if anybody is not happy with us. Fine, right? It's easy to get out of the relationship, and you don't have the marriage of the cap table, essentially, that makes all of those discussions much more complex. Usually what we see is that it more naturally over time develop into exactly that, right? The companies want to continue working with us, and then you also find solutions that include the cap table, either because it's end of maturity or because there's an interesting way to provide more funding, and then we can throw a bit of equity in the mix as well. So I think there's just a lot of flexibility in there. When it comes to collateral, and that's also the difference in our case, because we don't do pre-revenue, right? That also means that we can take the revenue at least partially as a collateral at the end of the day, right? I mean, it does not change anything in the day-to-day for the companies, but it's just basically in a worst-case scenario where basically things break down one way or the other, that we have at least a claim partially on the revenues. And that gives us just leverage to make sure a solution gets found. But on the other side, we want to have some collateral, right? Flexible and creative, and always finding the solution that fits for the different companies we talk to.
Stefan, you said that it also gives this possibility to have exit or end the marriage, I think, as you put it. But what if you have outstanding amount in the end, and as you said, you have kept in your agreements kind of open the possibilities for negotiations. So have you found anything challenging in the end when there is still unpaid amount?
No, not yet, right? Also because, I mean, the revenues get, as Ottomar said, the revenues get reported monthly, right? But basically, if I wanted to, and we do, essentially, every month, I can basically calculate how much would the company need to grow from exactly this point in time to make basically the cap within the maturity time frame, right? And then I can basically at all points in time update and compare this to what my expectation is in terms of what is reasonable, what is achievable and not. So very early on, I will actually know whether most likely we will end up with either a very small cap that the company will easily find a way to close themselves, right? Or whether we end up with a larger cap, and then we can early enough start the discussion of what we do. Is otherwise everything else healthy enough, and then we just refinance? Or do we need to find another way? I think that is super clear and super transparent for everybody involved. And on the other side, right, also for the companies, they know the same thing, right? So again, there is early enough alignment of interest to put a solution in place. And then I rather have the flexibility to actually have different options than just having one prescribed. But again, I think that that's the difference also in the situation and the maturity stage of the companies that we deal with.
I think what you just brought out is very important. So basically, you are continuously adjusting your analysis of the company, and not just for the foreseeable future, but for the entire maturity period, to have the certainty that everything is paid.
Yes.
So that is very important.
Yeah, and then that's basically especially of course we are completely happy to have a good revenue-based finance deal, right? And then it runs its course and everybody's happy it did what it's supposed to do. But of course, I think one of the huge advantages of revenue-based is that it can also grow, right? If basically the company is truly growing, and at least we measure basically our financing capability always in terms of the current revenues, then also in theory our financing capability for that particular company grows, right? And then deploying more capital into the company is really just a matter of basically changing 3 numbers in the contract or having a 1-page amendment, and additional funds are there, right? And so all of this, I would say, contributes to kind of a certain pragmatism around the whole method at the end of the day. Yeah.
Stefan, Ottomar, and Indrek, I actually have a question to all of you. In your experience, do you see this difference in due diligence process of acquiring equity investment or this revenue-based investment? So in your experience, is there a difference?
Can I start? I haven't raised any capital against equity, so I have no idea.
If I may add to that, as accelerator, we operate in real early stage, and due diligence process is really basic in that stage. So definitely, of course, I can say there is no difference. Meaning we are looking still the same things. Is this business model even remotely viable? We check whatever references there are to check. We do the basic legal check, and that's pretty much it. It's not too difficult. It's not too time consuming. So it doesn't make sense to skip anything or add anything there.
Yeah. And I think I would also say, just from the overall kind of topics we look at, etc., right? It's not too dissimilar from an equity investment, because you ask for the same things anyway, right? And then at the end of the day, the key thing is to understand how the business model works and whether it can function. I think what you have in case of equity investments is more what's happening at the end of the due diligence, right? That there are just different things. If I make an equity investment where I say I can live with whatever kind of setup or legal frames, etc., that are in place when I do revenue based, because I don't care, because but if I do equity and I have the feeling that this might create problems along the way, or this creates potentially problems from a setup perspective when we want to go for an exit, then I will, as part of the due diligence, start pushing on certain topics that they get fixed before I make the investment. And that's usually where the time-consuming and complex discussions come into play, right? When we say, no, I need you to rewrite those contracts before we can get in, or that from an equity perspective. That's usually where basically the process becomes more cumbersome from an equity perspective. But just in terms of looking at topics, the initial list is fairly the same. It's just of what do we focus on, and where do we need to have a discussion about remedies if anything gets flagged.
Have you seen that in this revenue-based investment, that the investor enforces the startup company, to go into revenue before the product is actually ready? So to already have the revenue with half-finished product. Do you see any risks in there? Or have you seen in your experience?
I think it always depends how early you go in with the revenue-based finance, right? So, and I can just talk to our approach, and I understand what Indrek is doing, and I think there it's no problem at all, because you already start with different perspective on how things go, right? And then how they can all shake out at the very early stage of the company. We try to get in when we can basically look at the business and say, product market fit is more or less achieved, right? That the product itself is stable enough that it can truly scale. That's also where we want the investment to go to, and that at least that's where we try to create confidence on ours that this is already there. So having said this, of course, always a bias to more revenue at the end of the day, but that is part of the relationship that needs to get built during the investment process, and the joint understanding of what really the priorities of the business are, and how it works, and take it from there. And I think that's, at least for me, always one of the good things. All my discussion time with the companies during the investment process, except for very few legal points, is really about how does a business work? How do we jointly expect it to grow? How do I expect it to grow? Have I truly understood how the simple A times B, price times whatever it is that gets sold, works, and how it scales, right? I don't need to spend discussion time on governance. I don't need to spend discussion time on a 50-page investment agreement and all of that. So I can fully focus on this, and hopefully the result is that there truly is a joint understanding and alignment on the priorities and what happens when. Yeah.
And perhaps also the fact that you don't need to spend time on discussing on the valuation. So I think that's also a very important factor. And the value is whatever it can accumulate in the future, but revenue based, not the actual company value. So I think
exactly.
Like from my experience, sorry to jump in. Like I can just quickly go over like our investment process. Initially, we got the no, the fabulous no, because it didn't make sense. But what we did, or how we approached this process, was that we immediately started taking action. You know, figuring out like, okay, where do we want to go? How we're going to do it? What is the roadmap for us? You know, and different stuff like that. And we immediately showed progress, and that turned the attention to us again, meaning that, okay, now we're doing something. Now we're actually you know, aligned with our goals and with our understandings. So but when it comes to paperwork, the paperwork was easy. The harder part was actually taking action and doing the work.
I wanted to comment on that pushing for revenue, that I have actually been on the board of technology companies where one of the investors started pushing for revenue with pretty much MVP. And it was a real fight there on the board, and it was equity investment. So eventually everything turned out well, and this company is leader in their technology sector right now, but it was quite nasty. So I understand that if from revenue-based, in the case of revenue-based investment, there is only a cap multiplier which determines the cap. Then of course the IRR of investor depends how fast the money comes back, and then there might be an interest to push the company to maximize the revenue, but it depends, I think, mostly on the particular investor, because if you mess up the relations too much with the company, the word spreads, and that is going to be the last deal you're going to do. So of course companies are doing their due diligence regarding the investors also, and you have to take care of your reputation, you have to take care of the founders and the overall business of the company. So I don't think it's too big a danger that somebody is going to aggressively pressure unduly to maximize the revenue. I don't think it's an issue.
Okay.
If there are no more questions or comments, or is there somebody wanted to add something?
No. You can. You had a point in mind.
Yeah. Sorry, I just slipped my mind now. Let me think for a moment. There was a question I wanted to ask from the round table.
Okay, but at the same time, maybe I will take one from the comments as well, and maybe think about as well. Like, okay, we are talking about the pros at the moment if everything's going fine, but what happens actually? What could be like the negative sides, or not everything is always going well. So what happens when you can't pay up, or what could be otherwise, like let's say the cons side of this deal? It's still a very expensive loan, isn't it?
So I'd say those are two questions, right? But they are actually quite nicely linked, because first of all, if the revenues, etc., don't develop as planned, right, going or slower, etc., what happens firstly is that the revenue shares that I collect are smaller. It's less money to me at the end of the day, and so that is what's happening. And of course, it just means that over time, as we go towards the maturity date, it triggers the discussion earlier in terms of, hey, how early do we need to start finding a solution, right? And I truly believe that the only problem ever kind of is if then the company founders or the management of the company is not willing to actively have those discussions. What do we actually do now? Where do we start thinking about how to get out of the loan? Can we actively discuss what options are to improve the development again, etc. Right? Down to the point of saying, I mean, at least one of the benefits for us investing into software businesses and investing into software with a recurring revenue stream, right? Even if you say, hey, somehow, for whatever reason, we cannot have a lot of future expectancy on growth, right? What you can do in those companies is, well, once you've hit a certain critical mass, at least, that you can say, okay, fine, the product itself will not be developed any further beyond the pure minimum. So we can actually reduce cost. We're sitting on a product essentially that generates 80, 90, 95% gross margin. If we reduce cost to the minimum, then at least for a period of time, a couple of years, the company just creates enough net cash to basically make sure that everybody who put money in, and that includes the founders, can get money out, right? Yes, trajectory changes and all of that, but there are ways to actively also manage around this if really it needs to be. The only occurs when the kind of this point of realization, or at least the point of discussion around different options. Yeah. So I think that what it also means, is, connecting to the second question, is that means if I make a revenue-based investment, I take the risk that the revenue shares are not exactly, or the complete opposite of what any good pitch deck would suggest, that is showing exponential revenue growth development over the next couple of years, right? I believe, with regard to my return expectations, that risk. I take the risk that revenue flat. I take the risk that revenues might all down. I take the risk that revenues are incredibly volatile. So, and if you then compare what my return expectations are, which are of course much more than a standard debt with all the different remedies that come attached to it, but still, on the other hand side, if you say, I take the revenue-based investment and what it costs me and compare it, and that's a discussion we all want to have. I take now a 20% dilution on the cap table. And what is those 20% dilution on the cap table worth if I do an exit in a couple of years down the road? And how much would expect to get 20%? It's of course much more or more expensive, if you want to use that language, than the revenue-based loan.
I would say that the expensive is subjective in this case, because it's
yes.
if you have the capability, it's not expensive. So
Yes.
1% interest on a regular loan can actually be much more expensive for a startup than this revenue-based investment loan. So it's
Yes.
if it is expensive to everyone else, then for the company it's in accordance to its capability.
Yes,
And
I think also from a risk perspective, right? If you would compare to a regular loan, and there are options where a couple of months are actually, or even a half year is bad, or something like Corona happens and changes, right? Then with revenue based, the difference is at least that the revenue shares you pay down to very little potentially, right? But if you have a standard debt, then the same amount of interest is due every month. And basically, if then also a larger repayment tranche falls from a timing perspective exactly into shorter or longer period of troubles, then you get into a true crunch. And then it suddenly becomes existential. The way we build and the way we try to operate it is to say, we have the way that our loan should never bring or basically for the company itself in terms of creating an existential revenue-based finance. That's what we want to avoid, and standard loan that to some extent.
Yeah, that's interesting. Actually, your last comment. I wanted to ask about it. Hypothetical situation: if the company reaches certain decision that they need to bring in equity round again, and the equity investor is not happy to see that some kind of money is walking out the door and not serving growth purpose in the company. How have you faced this kind of situation before, and how do you behave in that situation? Hello, Stefan?
Yes. And at least in our experience, right, is to, but that has also fundamentally changed over the last 3 years. So we had this 3 years back when equity investors said, no, we don't want any loan on this, and we don't want any cash basically on a continuous basis also going out, etc. I think this discussion that people have, or the market overall, has become more aware of different options that are out there. Everybody has at least a rough understanding of a revenue-based finance, this and how it works. Those discussions are left.
Good.
From my experience, like in practical terms, we have been negotiating with some strategic investors. This is not like active thing that we are working on a daily basis, but we have kind of thought about it or ideated about it, like what if we want to go for another round as well, and what are the options, right? So yes, so far we have heard comments about it, like, hey, you have this loan or investor on board with you, like it looks like I don't know if we're kind of, if we feel confident about it. So this is what we've heard so far. But who knows, like in the longer run, I think it's totally like communicatable in a way that this was in the beginning, right? This happened in the beginning for us specifically, but let's see.
Okay, correct me if I'm perhaps over the kind of limit here, but in my personal opinion, Finnish startup investment market, for example, is much more conservative than in the Estonian one. For them, the convertible note is pretty big innovation. So if we are here struggling to bring this kind of revenue-based financing onto the market, then I think for Finnish investors, this is something really unheard of. Or do you have any context? Is anybody from Finland listening right now and perhaps can comment on the comment section?
There was one question popping up here that for which stages of a startup is recommended to use revenue-based investment. Would anybody comment on this? To me, it seems rather as 99% seems like there is you need to already have a revenue, so it matters a lot, as well as what are the funds and companies actually offering this instrument. But what would others say?
Well, we do it in pre-revenue stage, but I guess we are not conventional.
So at least from our side,
as said already, we are combining it also with convertible notes. So it's perhaps in not all cases it's pure RBI also.
So you cannot go much earlier than pre-revenue. Perhaps post-revenue is.
Well, we at least expect that there is a company and certain proof of the market product fit. I don't know if they have tested MVP or well, it then depends on particular case, but it doesn't have to have recurring revenue. Yes, in our case. But I think we are more of an exception than a rule. I would say, Stefan can correct me if I'm wrong, but I would say like maybe 20K MRR is the minimum threshold, or what do you think?
I think there's some connection problem.
Okay.
Nobody can say that's still.
Okay. I will try to get in again separately and then come back to the question.
Yeah, no worries. Okay, let's see if we got some questions here as well that we didn't answer before. It goes quite specific here, for which Stefan could comment as well, but he disappeared at the moment. But so there is one, for example, like what is the method? Like for how long does the instrument last for? So Indrek, would you have a comment on this? Like, for example, in the B9.
Perhaps you should repeat the question for Stefan, because Stefan knows the general market practice better than I do. I know what we are doing here, but we as I said, we are more exception than the rule.
Yeah, but I think it's back. We can come back to the previous question that you asked, I think. But so.
Well, the previous question was that from what revenue threshold can the company expect to get the MRI in typical case? I propose that maybe like 20K monthly, but
he's gone again. We lost him.
He's gone again. Okay, well, that's all right. Yeah, but I think if Stefan is dropping out already as well, and we are hitting 1 hour. So do you guys have anything as well on the mind at the moment that's still uncovered?
And we have Stefan back.
Okay. Yeah, sorry. I hope this works better.
Anyway, the question was now we lost Ottomar. Question was that what is the minimum monthly recurring revenue level at which the company might reasonably expect to be qualified for this kind of funding?
Yeah. So I mean, for us, it's around 80,000 euros, right? So we want to have at least if I multiply it by 12, I want to get close or be at the 1 million in annual revenue, at least from an annualized basis, preferably even higher. But I think that's also just how we structured and focused our investments. I think the tool of revenue-based finance in general is pretty malleable, that you can basically also create variants of it for different stages of the company. I think, yeah, I think it always comes down. You have a lot of companies also in Germany who are doing much more short-term oriented revenue-based finance with smaller tickets, also in earlier stages. But those financing constructs are usually geared towards a much faster turnaround of the financing facility. And for me, it's just a different thing, right? There are some elements that are the same. Yes, there's a revenue share and there's money going in and money coming out and all of that. Yes, all of this is clear. But from a kind of product philosophy that we have in the way we want to establish revenue-based finance with our portfolio companies, and from what I would understand also, Indrek, you have a very specific view on why this makes sense, etc., right? Then there are also just those other guys out there who do it differently. Yeah. And then I think you always just have to test, is the fit right for the individual variant. And at least we at some point started to focus, always looking at options for the future to say, okay, can we create a different variant of the product for a different kind of use case, right? And that will most likely also happen over the next couple of years. But it's always good to shape the product in a way that like with any other kind of company, right? At the end of the day, financing is also just a product, and it needs to fit the particular target customers or the target segment you address, and for them it needs to work, right? And you will rarely have one size fits all, and I believe it's the same with revenue-based finance.
Agreed.
One of the reasons why we are looking also this instrument is that we look at specifically from early stage accelerator point of view, and the Beamline Fund is accelerator program. So typically in such early stage companies, when you make the accelerator investor joins the accelerator investment pool, then you can expect the average exit take like 10 to 12 years, as we all know, and maybe even more. So you start from really early stage, and then you are on board for the whole ride. And there are many things that can go wrong during the ride. The companies who reach successful, really good exit, we have all heard about this. 1 of the 10 will succeed, and so on, and even less. Well, if the accelerator does its job properly and selects really, really good and high potential companies, then the probability is probably higher, but it's still not very high. The percentage of companies which get to the revenue is significantly higher. Even after they have reached the revenue, eventual exit might not be too good for the investor, because just competition catches up, many other things go wrong. Revenue doesn't necessarily mean that you're profitable terribly, and that you can maintain the growth too long, and that you are somehow protected from the competition. And what is good thing about the revenue is that it, as I said already in the beginning, it arrives significantly earlier than this 10 to 12 years when the investor can expect the exit to happen. So from investor's point of view, yes, you are probably going to miss out from the unicorns because you are not getting the equity stake, but you get your money back within 3 to 4 years compared to 10 to 12 years plus reasonable IRR also. And from investor point of view, over the portfolio, it's not a bad deal. And our investors agree with that. So
And I
that's
think
why
actually,
we're doing it.
and I think that's also one point where, again, I think the one size fits all comes in an even different way, right? Whenever you have an equity stake, I mean, what are your options to ever monetize it? At the end of the day, there needs to be an exit or some kind of other mechanism that is complicated. And we fundamentally believe also that there are great companies out there with great founders and entrepreneurs who want to build their company. And yes, the whole business model or the niche where they're in, it might never become a unicorn. The guys or girls might never want to truly go after an exit, etc. Right? But why should those people not get financing? Or why should those teams be pushed towards then pursuing an exit or organizing an exit for their investors if there are just different ways out there? And we just believe there are fundamentally great investment opportunities in that sense out there that simply do not get covered by anything else in the market.
But in order not to lose out on the investment possibility to a unicorn, do you see the possibility of attaching, for example, a subscription right to this revenue-based investment model? Subscription right in the first financing round after the...
I believe I don't need it. So because usually, right, if there is a financing round where it's attractive, and if we have established a relationship with the company, then there should never be a problem to participate, right? So if at the end of the day, it all comes down to the team, etc., right? And especially still in those stages of growth and kind of the company shapes. And if the guys or girls have worked with us for a year or two already under the revenue-based construct, and then they don't want me on the cap table, if I want to, but then I also don't want to be there, you know? So I think I don't need to have this right in the contract, because I think the opportunity will arise organically and will be there almost anyway. Yes, of course, I need to position myself that to have that opportunity and not just rely on what's written in the contract. But I think that is also par for the course.
So basically, you don't rule out the equity investment, but you don't want
No, we
it to
don't.
be a contractual obligation of the startup, but you want to earn your right to invest.
Yes, exactly.
That sounds very logical.
And so also again, right, then the interests are aligned. I mean, the portfolio company wants to earn the right to get more investment, and of course we need to prove that we are a reliable partner, that we are a helpful partner, and that also we can be a financing partner for the future, and also with something that is beyond revenue based.
And this is, again, in my opinion, proof that this investment vehicle is particularly suitable for mature investors who think beyond just their own revenue and capital gain.
Or crazy enough investors like we are.
If you are pre-revenue, then definitely the crazy factor.
That is crazy.
I just wanted to add that we are not probably, we have differences more than similarities with Stefan, because I just explained why we are doing it with a principal accelerator investment, because investor get their money back faster. But they don't get, as I mentioned, they don't get, with this kind of structure, they don't get any chance to participate in this kind of unicorn cases. But if you know anything about business accelerators, then accelerators usually have in their contract this follow-on investment option, meaning that out of like 10 company batch, 1, 2, or 3 best ones, which really show superb results, they can get additional follow-on investment. It's a limited size, usually 100 to 250K, depends on the accelerator. With the terms which at that growth stage are really kind of lucrative for the investors who took the risk with them in the early stage. And in that way, I would think Beamline is slightly old-fashioned. That yes, in the principal amount, the whole batch gets their monetary grant in exchange for this revenue-based investment deal. But then our investors still would like to get this kind of follow-on investment option for the best of the best, and this usually is convertible note. So again, we combine the revenue-based investment with the convertible note here also. But then, as all business accelerators usually are, we are somewhat flexible with our terms. So with every company, there are certain starting positions from where we start our negotiations with the companies, of course, but we are, to a certain extent, we are flexible.
So maybe one more question from the comments is that, and that's more for Stefan, that do you have a basis for calculating as well, like how big an investment a company gets, for example, based on their revenue or their vision?
Yeah, so fairly simple, right? Our basis is the current revenue. And our kind of rough threshold for the initial investment is 30% of current revenues, right? So if you have 3 million in revenue, basically our starting investment can be 1 million. We can then also, depending on situation, and especially if we're not talking about the first tranche, also go above and also significantly above the 30%. But that's our first, always rough indication of whether this can make sense, right? And what we've discovered over time is then also where kind of a sweet spot for use cases is. The majority of our portfolio companies are B2B companies, and of course, largely in the software space. And the reason why it works well with revenue-based is that growing a B2B software business in many cases is more about than adding competent salespeople and marketing people to the team, right? And then you, of course, in B2B with sales cycles and everything else, you just have quite a period of time before additional sales staff becomes productive and basically creates then the revenue that contribute to the growth, right? So and for this kind of the kind of investment required, the kind of investment we can give, there's a sweet spot there that works one way or the other, right? I think revenue-based finance in the way we do it is less suited necessarily if your business relies on kind of heavy investments in, for example, online marketing, etc. And that's where kind of just already just a huge share of current revenues go. There are, but basically, and there's also partially also the other companies I was talking about earlier, where they have kind of made a version of revenue-based finance that works into those use cases. But for the larger tickets that we try to do, and the way we structure it and the kind of long-term perspective we usually take, that's not necessarily a sweet spot for us, right? Because then you're talking about suddenly, almost by definition, needing revenue shares that are above 10%. And then we feel it does not really kind of create long-term sustainability in the business necessarily.
Okay, all right. I guess we can pretty much wrap up over here because we got the comments, we got quite a lot of topics covered. At the moment, round 2 is looking for investments or companies as well on a continuous basis. We got B-Mine Accelerator waiting for crazy ambitious ideas at the moment to save our planet. And we got Miriam, who is ready to help from the legal side always. And we got Ottomar, from whom you can ask for his experience or just to sleep well with his.
Oh yeah, that's
on
what
your
I
right.
wanted to highlight. Yeah.
Exactly.
When you want to be better at being awake, then call me.
Yeah, so there is, as you can see, probably it's totally accident that you have this product on your right.
This one. You mean this one?
Yeah. So
it's like a James Bond movie, like accidental product placement. Yeah.
Exactly.
Okay, now we have the gun on the wall. Would you like to show it to us?
Oh, you mean this one? Okay, this is weighted blanket, which we developed in the second half of last year, and we're already doing the third generation. So we are like a betting Apple company.
Cool. That's all right. So as you can see, viewers, all the stuff is like all the help is here. If you have any questions, write to any of us regarding that, and happy to have you. So have a great weekend, everybody.
Mm-hmm.
And
Ciao.
Thank you.
for joining.
Thanks for having us.
Yeah.
Bye.
Bye.